Hi, I'm Ankita Amajuri from HCSC2X. I'm working under Mr. Kunal Gupta, and my project is called the Robo-Advisor for Portfolio Management. The objective of this application, which was created in R using the Shiny framework, it is to develop a black box quantitative trading system. Now, you ask, what is that? It is a system where a stock is bought and sold without the interaction of a user based on certain insights. While it isn't artificial intelligence, it does involve a computer deriving insights from data and then buying or selling a stock. In our case, we're using the SPY, which is an amalgamation of the Standard and Poor 500 index. It's an ETF, an exchange traded fund. So it's a financial instrument based on the entire S&P 500's performance. Here we implement two kinds of trading strategies: trend following as well as mean reversion. Trend following strategies are ones that say what goes up will continue to go up. So you use that train of thought to buy or sell. And mean reversion strategies are those where you say what goes up will come down. The price will eventually come back to its mean. And the goal is to really make as much money as you can. You also manage risk and performance metrics for this Robo-Advisor. We optimize our strategy parameters. I'll explain that momentarily. And at the end, we implement a walk-forward analysis, which is basically you want to avoid snooping into your data. You know that a certain strategy works for a certain data set. Now, you don't want to use that bias to be creating that same strategy for another data set. It's like the rationale for this project was derived from the fact that most people who invest their money in the stock market lose it. In fact, 40% of those who invest in the stock market lose more than their initial capital. Let's say I started out with 1,000 rupees. I'll not only lose out that 1,000, I would lose even more than that. So that's 40% of people. What often people fail to realize is that the stock market isn't something that's left to chance. It isn't just luck that people are making money off of. They have key insights. They have a lot of technical indicators, a lot of metrics that they use to make these good decisions. Now, what this Robo-Advisor does is that it provides all those insights to the common man in the form of an application where the person doesn't even have to make those trades himself. And there is a lack of this in the market. Now, very large investment banks like Goldman Sachs, JP Morgan, they provide these to their clients at a very premium price. The multi-million-dollar clients, they get to use robo-advisors. And even otherwise, let's say you didn't want to use the robo-advisor, but you still wanted to invest your money. You could either leave it to luck and lose all your money, or go to a financial advisor who would charge you a lot of money. And, let's say you had a profit of 40,000 rupees. Paying 25,000, you're left with 15,000. Is that really worth the investment? So the goal of this application is to provide an open source and reliable means for one to use quantitative trading. Quantitative trading is where trading is automated, made by the system, and there's no user involvement. So based on technical indicators, people make these trades. And it really works. Now, getting into the methodology adopted to create this Shiny application, we start out with implementing trading strategies. Now, how do we create these trading strategies? We get technical indicators. Simple moving averages, exponential moving averages are two examples. These are called our technical indicators. So we look at also the categories. Like I said, trend following or mean reversion. The frequency, is it low frequency, high frequency, or ultra high frequency trading where you're buying and selling to the millisecond? You need to identify your trade signals and then outline your trading rules, as in when should you exit the market, when should you enter the market. Let's say you start out with 10,000 rupees. If your account goes below 8,000, you quit the market. Things like this. Now, our two trend following strategies are simple moving average SMA, MACD, which is moving average convergent divergence, and the three mean reversion strategies that we have are called Bollinger Bands, RSI, which is Relative Strength Index, and Statistical Arbitrage through a metric called the Z-score. So next, this was step one, implementing the trading strategies. Step two was to report your strategies. You want your trading statistics, which could be your net trading and profit loss, your equity curve, which is, an indicator of how much money your account has. You have performance metrics like your annualized return, your standard deviation, and something called the Sharpe ratio, which I will explain soon. And then you also have your risk management. Risk is essential to something that involves money, of course. It is risky to anything involving money is risky, so we have made it a point to include. Our next step is to optimize your strategy parameters. Now what this means is you look through a set of parameter combinations, and then you maximize your risk adjusted values based on metrics like the net trading profit and loss, your drawdown. Your drawdown is essentially, let's say your portfolio makes a lot of trading losses and your maximum profitability goes below your current profitability. And then, of course, ratios based on that. Next is to perform walk forward analysis. Now this is the most crucial step here, where you're avoiding overfitting or snooping into your data. Sometimes you have a data set which it looks really good when you have a strategy that's working excellently. Oftentimes, to make it work even better, we might tailor our strategy based on the bias that we have from our data set. Now this is something we want to avoid. It's like shuffling a deck of cards it's like doing a magic trick from a deck of cards that you've sorted. Now it'll work only as long as your cards are sorted, but let's say someone shuffled it, it's no longer going to work. And that's the nature of financial markets. It's like the data is like a set of shuffled cards. You always want you want strategies that work on any kind of data, regardless of what patterns, what trends or whatever it has. You want your strategy to work, and that's why you perform a walk forward analysis. I'll explain that in more detail later. Now I'm going to go on to the strategy implementation and explain the various different technical indicators used. Now the first thing I'm going to explain is our two trend following strategies. We have the simple moving average on the left and the MACD on the right. MACD stands for moving average convergence and divergence. The simple moving average uses something called a regular moving average. Here, let's say we're using a 5-day moving average and a 20-day moving average. So your sell signal is generated during these crossovers. You'll see these red and blue lines. So when these intersect each other, so the red line is the 5-day moving average, which reflects how the market's performing in the last 5 days, and the blue line indicates how the market's performed over the last 20 days. Now, if the performance over the last 5 days has been much better than that over the last 20 days, you would want to buy. And if you had the opposite crossover, you would want to sell. This is what's going on with the SMA. The MACD also uses a kind of moving average, but it is an exponential moving average. Here, if you're using a 10-day moving average, you don't want the date from 10 days ago to have the same weightage as what happened yesterday, because of course what happened yesterday is more likely to influence what happened today. So more recent data has more weightage in this case, and so that's an exponential moving average. And that's the smoothing curve that you see on the bottom part right over here. The red is the smoothing curve and the white is your actual data set. And here also you have crossovers, and so your signal occurs when the indicator crosses above or below its smoothing signal. Moving on to our mean reversion strategies, we have three of them, starting with Bollinger Bands on the left. Now here your trading signal occurs when your asset price crosses above or below your indicator bands. You could see over here that what's in the red, it's not really a line that you have to see a crossover with, it's an area. The area within the curve is safe, but when it goes outside or outside of the curve, that's when you decide to buy or sell. On the right here, we have the relative strength index, and again, another mean reversion strategy. All along till now, we've seen crossovers where we see an intersection between any two lines, and that's when we decide to buy or sell. The next two, RSI and the Z-score, are threshold-based signals. So an RSI band threshold signal occurs when the indicator reaches a certain banded threshold. Z-score is very similar in the threshold sense that your signal occurs when your indicator reaches a certain banded threshold, and here your indicator is a Z-score, and it's a very intuitive calculation, and we'll see that when we look at the code a little bit. So far we've been through part one really only of our trading strategy implementation. That was the implementation. Part two is reporting your strategy, where you report your risk metrics, your performance metrics, and your trading statistics. Now, if I took you into the application, of course, we're computing a lot of different metrics here, and those metrics are used to gain insights into what was a good buy and what was a good sell. Here, I'm showing you two different strategy reporting metrics. The first is your maximum drawdown. That's the one on the left, and this is essentially where your cumulative returns, how much money you're making or losing. When that how much money you're making based on profitable and losing trades, when that goes below your maximum cumulative returns, and this is usually the result of several lossy trades, then you have a drawdown. So this is plotted in this graph over here. The bottom one is really the most insightful here, where you have your maximum drawdown, and then right above it you see your daily returns, and you see the days where you're way below the mean or below zero. Those are the days where the drawdown is well below the black line, and the one on the top is an indicator of your cumulative returns. On the right you have the equity curve, and this is a very simple representation of how much money is in the bank. Still in part two, strategy reporting, we have performance metrics which show you whether or not you're doing well, whether you're making money or losing money. Of course, the previous part also talked a little bit about that. So you have your annualized return, which is a cumulative product of how much money you're making every day. The daily trading equity is essentially how much money you're making every day, equity returns, I mean. Now your annualized standard deviation, on the other hand, it corresponds to whether what you're doing every day, can that be done every year? Kind of like magnifying what you're seeing. The Sharpe ratio is a statistical not an indicator, but a statistical metric over here, which counters in risk. So you convert your risk-adjusted returns to a yearly frequency. Here I have the formula for that. However, here in RStudio, we just use the function that QuantStrat gives to us. Still in part two, strategy reporting, we also have risk management metrics. The three big ones that we implement are the MAE, the maximum adverse excursion, the MFE, the maximum favorable excursion, and the Kelly ratio. MAE is on the left and MFE is on the right. MAE is essentially a difference between the minimum and the initial trade equity. Its percentage is it's represented in a way that it's a ratio of the initial buying transactions and the asset closing price. The MFE is a difference between the maximum here and the previous initial trade equity. It's different. Moving on to part 3 here, which was optimization. I'm going to keep it simple here. I've tried to explain as much as I can in the PowerPoint, so I don't want to sound too much like I'm just reading off of here. So your strategy parameter optimization is where you look for a set of parameters that you can optimize based on historically whatever profited you the most after risk was adjusted for. So often you will try to maximize things like your net trading profit and loss, your PNL, your maximum drawdown, your profit to maximum drawdown ratio. The way to do this is through searching this set of parameters. You could do it one of two ways, through an exhaustive search or a constrained grid search. In an exhaustive search, you look at all the possible indicator parameter set combinations. A constrained one, on the other hand, looks at a limited set, a constrained set, like it says. And so often when you have an exhaustive search parameter set with so many parameters, you'd often need parallel computing, or let's say your data series is very long. Ours is just 365 days, but often you have data sets that are 20 years or 40 years, then you may require parallel computing to be able to achieve that. The last part is walk forward analysis. This is really what shows us whether or not our strategy can be sustained in the long run. Because if you look at the equity curves for trend strategy 1, trend strategy 2, they're doing really badly, but then it's only because the market was so volatile. They're not bad strategies at all. And similarly, the mean reversion strategies, they were doing excellently because the market just kept going up and down, up and down. Now, using this, you don't want to derive the conclusion that trend following strategies are bad or that mean reversion strategies are good. This bias is formed only because our data was a certain way. So we perform a walk forward analysis, which I keep going back to the concept of shuffling a deck of cards. What if you got a different set of cards? Would you still be able to perform your magic trick? So here what you do is you split your data into in-sample data and out-of-sample data. So essentially it's almost like splicing a set of 52 cards. You're shuffling them. You perform your step forward cross validation based on your optimized indicators from the last step on your in-sample data, and then you use that with out-of-sample data, and then you continue to repeat the steps with various different splices of data, in-sample, out-of-sample. So your training data is the in-sample, and you test that with your out-of-sample data. So there are two ways to do this, is with a rolling one. This is the one that we implement here. And the other is called a step walk forward analysis. A rolling one usually uses contiguous sets of data, and this is what's most effective. And what we've been able to see is that our strategies were excellent. They worked in all these different scenarios. If we had a different data set. Now let me explain 2015 a little bit to you, our data set. That was the year oil prices were very low, and that's the reason the market was volatile and the mean reversion strategies worked. The markets weren't stable, so you didn't see a gradual uptick in the trend, and that's why the trend following strategies didn't work.